Welcome to the What Mortgage Show. I'm Stephen Little. First-time buyers looking to get their foot on the housing ladder face more challenges than ever before, with many finding themselves squeezed out of the property market due to soaring house prices and deposits. With us today is David Hollingworth from mortgage broker London and Country, who's going to be explaining what first-time buyers can do to improve their chances of getting a mortgage. Hello, David.
Hi, Steve.
Good to have you back again.
Thanks.
So, getting on the property ladder can be a long and complicated process. I mean, what should first-time buyers think about before applying?
Well, I think we tend to see first-time buyers initially in a bit of a chicken and egg situation. So they're not sure how much they can borrow, and they're not sure, therefore, what property might be within their grasp. So getting those kind of figures in play is really important. So understanding the kind of prices that you might have to pay for the kind of property that you want, that's going to be helpful. And then you can work back from there and get a feel for how big is your deposit and therefore how much you might want to borrow. So you can then start to work out whether you're in the right ballpark. It's also worth looking at how you're going to stack up. So a lender's going to be running the rule over you. So getting hold of your credit report can do no harm. If you're a bit concerned about whether there was something showing on there which a lender might just not be quite so pleased with, you can get your credit report quite easily and very little or no cost. So have a look at that and then just look at the budgeting. How much cash have you got for a deposit? And not just deposit, but also the other costs that come with buying a home. Things like stamp duty, legal costs, survey costs, that kind of thing. That will give you a better feel for what you really need to borrow and just what properties you might be able to aim for.
All right. How much can you borrow as a first-time buyer?
Well, there was a time when that was a simple kind of one-size-fits-all income multiple. Times have changed and lenders are really looking, of course they're looking at your income. They want to know that you're going to be able to afford it. But they'll also be looking at what items of expenditure you have. So other credit commitments, certainly they'll be looking at, but also things like utilities, any childcare costs, travel costs, that kind of thing will start to be factored into what they call an affordability calculation. Now that will vary a little bit from one lender to the next, so don't assume that one lender's result is exactly the most you can borrow. It pays to shop around and just get a better feel for what your own individual situation looks like.
And what about the deposit?
Deposit, now bigger the better, I'm afraid, still holds true. There are plenty of deals now available to as much as 95% of the purchase price. At one time there was virtually a handful of those, so it's a much better position there. However, you will still pay a higher interest rate on those deals. So if you can push to a bigger deposit, even getting to 10% will push your available mortgage rate down rather a lot. You know, it can be more than 1% you'll be taking off, for example, on a 2-year fixed rate. So that will pay. Again, if you can get to 15%, again, you open up a wider range of options and it'll be lower rates. So it is bigger the better, but there are options for those with small deposits too.
How do you go about applying for a mortgage?
So once you've got the purchase price you know that you're going to be looking for, you might want to be sure whether you can borrow that. Now, one way you can do that is through an agreement in principle. Most lenders will offer that as an option. Just be careful not to do one with every single lender that you're considering, because of course they may carry out a credit check and that will show as a footprint on your file. So if you do rack up a lot of those, that could start to weigh against you, ironically. Or talk to an advisor. They'll be able to talk through your income, your outgoings, and just give you some comfort that you're actually looking in the right kind of ballpark in terms of what you can borrow. And then they can get down into more detail on the exact product and lender that suits your situation.
What type of mortgage should a first-time buyer choose?
Well, again, it's horses for courses. So some people will still like variable rates. Perhaps they're more likely to come without an early repayment charge, so that might be helpful for them. But in most cases, I would suggest that first-time buyers tend to be on the more cautious side. So they'll tend to go for a fixed rate. And then it's a question of, well, how long do they want to fix in for? There will usually be a penalty if you need to review the deal within the fixed rate period. So just think about that. How long are you going to remain in the property? If it's over the medium term, then you might like a 5-year fix, but they will be a little bit higher in rate than you'll find on a 2-year deal. So it's just weighing up those costs, but fixed rates give budgeting certainty, which first-time buyers tend to like.
Are there any schemes for first-time buyers struggling to get on the property ladder?
Well, there's plenty of different types, and it really depends what the nature of your issue is. Bank of mum and dad has become really important for many first-time buyers' hopes of buying. And some lenders have looked to that and said, well, how can we incorporate that help to maybe edge rates down even for those with only small deposits? So perhaps using the parents' cash or equity in their property as additional collateral, which might just get the child a slightly better rate, even if they're borrowing up to 95% of the purchase price. Those are the kind of different options that you might want to explore if you are looking for help from parents.
What about government schemes such as Help to Buy?
Yeah, Help to Buy has been a real boost for the new build sector. So that's still available. The equity loan option, which could give you up to 20% towards the purchase, or 40% if you're in London. That means that you only really need 5% to put down yourself, but it does help with affordability because you might only need to borrow 75% of the purchase price. So that can be a real help, but it's not free. You will have to pay it back. It's no interest charge for the first 5 years on the equity loan. Then you'll pay a small fee. When you come to sell, you'd have to pay 20% of the sale price back to the government.
David, thank you for joining us, and thank you for watching.